Okay, good afternoon. I'm Bill Kennedy, GIC Vice Chair of Programs. On behalf of the Global Interdependence Center's Board of Directors, welcome to today's executive briefing. Throughout this year, the GIC has been honored to bring you nearly 24 virtual and in-person events. And I'm excited to announce that through year end, we will host another dozen virtual programs, including new content from the GIC's College of Central Bankers and a continuation of the David R. Kotok Global Healthcare Series. Today, and in coming months, we will be covering very timely and very important topics, including monetary policy, crypto, and central bank digital currencies, China-US relations, and the economic impact of long COVID. So please watch your email inbox for your GIC invitations to this exciting lineup. Now, this afternoon, we have a very special agenda covering the Fed's evolving role in the financial system with two longtime GIC members and supporters. Lisa McIntire Shaw, who's the founding partner of Cygnus Asset Management, and Danielle DiMartino Booth, Chief Strategist of Quill Intelligence. Lisa, we thank you for serving as our moderator today. The virtual floor is all yours.
Thank you so much, Bill. I'm really happy to be here today and happy to be part of the continuation of the Global Interdependence Center's mission of continuing dialogue about economics globally. As a reminder to our guests, this event is being recorded and the replay will be available on the GIC website later today. I'm excited to say that joining us for today's discussion is Danielle DiMartino Booth. Danielle is the CEO and Chief Strategist for Quill Intelligence, which is a research and analytics firm. Prior to Quill, she spent 9 years at the Federal Reserve Bank of Dallas, where she served as advisor to then President Richard W. Fisher throughout the financial crisis. She's the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Having said all that, she is indeed a very sought after speaker and commentator on all things Federal Reserve and all things monetary policy. So we are very grateful and honored to have Danielle join us today. Before we begin, we'd like to take a quick poll of our audience. The first question is, for our poll, the Federal Reserve has carefully and deliberately expanded its presence and reach into the plumbing of the financial system. Are any of these actions tantamount to making monetary policy in the traditional way we perceive as easing or tightening policy? So if you'll just take a few moments and answer that simple poll question, we would appreciate it. Okay, it looks like most people have answered. Yes, I think we should so far we've got about 67% of the people participated in the poll, and 57% say yes, and 43% say no. So that's interesting. We are definitely going to. It's going to be a great discussion because there's a variety of opinions on that very topic. So with that, we'll begin today's presentation. And welcome, Danielle. Thank you.
Thank you so much for that gracious introduction. I really do appreciate that. If you wouldn't mind, before we get into kind of the questions and a lot of the inquiries and getting to that question, that poll that we just saw pop up on the screen, the results thereof, I thought I would give my best version of what it means when there is too little liquidity in the system and what it means when there's too much liquidity in the system, because in very recent history, we have seen examples of both. In 2018, when Jerome Powell was fairly new to his chair, to his position as leader of the Fed, there was quantitative tightening going on at the time. I think what the Fed did not anticipate, and this is quite relevant, is that at the same time that the Fed was endeavoring to methodically and deliberately and slowly shrink the size of its balance sheet, shrink the size of its treasury holdings, that foreign central banks in a negative interest rate world were also seeking out to find yield. So they were pulling money out of the system and parking it at the Federal Reserve in New York, again, looking for a little bit of yield when they had negative interest rates. And at the same time, because there was stress in the system, there was a big increase in actual cash in circulation. So at the end of the attempt at quantitative tightening, you may remember they had to pull the plug several months even before Jay Powell had announced double the amount of quantitative tightening had been pulled out of the system. That is a situation in which there is a dearth of liquidity, a lack of reserves, and therefore the lack of demand sent the price of money much higher. That was problematic, and it ended up catalyzing the Fed launching what we called at the time not QE, kind of a technical adjustment, even though the size kept growing as a factor of time, which was the banking system, the financial system trying to say, we need actual reserves, we need actual quantitative easing. But quantitative easing, Jay Powell and Lael Brainerd especially, who is and has been the architect of a lot of this plumbing, a lot of these plumbing changes, they were saying at the time, technical, mechanical adjustments cannot be conceived as easing of monetary policy in the same way traditional QE would be associated with easing. And that's why for lack of a better term, they needed a black swan event at the time in order to begin injecting real reserves into the system. Boy, did they get it with the pandemic. And we switched literally overnight into a system where trillions of dollars of reserves were being pumped into the system. And we ended up with a situation that we've seen continue to grow even through the last few days, where there's too much cash in the system. And when you've got too much supply in the system, then the price for something tends to decline. And that is what we have seen with the Fed's reverse repo facility, that has been used increasingly, mainly by money market funds. And if you will, if you want to think about this as just a visual, the Fed is trying to fill up a bucket by quantitative easing, by buying 80 billion in treasuries per month and 40 billion in mortgage-backed securities per month. The Fed is trying to fill up a bucket and ease monetary policy. But at the same time, the reverse repo facility, the bigger it gets, and right now it's 1.2 trillion and counting, and expect it to increase as long as there are no bills being issued, which since July the 31st, there has not been any net issuance of bills, notes, or bonds. But the reverse repo facility is becoming a permanent form, if you will, because it's daily of liquidity being pulled out of the system. In other words, holes in the bottom of that bucket that the Fed is trying to fill up. So a lot of moving pieces here, but I'll just say that we went from having too little in the way of reserves in the system now to way too much.
Danielle, do you have any additional thoughts before we do open it up for questions and answers?
Well, I really would like for this to be a little bit more interactive. I will say that there is a next step, and the next big step, because the Fed has now established a standing repo facility. So if we do have the pendulum swing back to where it was, if the Fed was to ever attempt quantitative tightening again, even a taper as it's being discussed, and we're expecting to hear from the FOMC tomorrow, it needs to make sure that they never see those overnight cash rates spike again. So at the July FOMC, they announced the establishment, and there had been a very long, drawn out debate within the Fed as to whether or not they should establish a permanent standing repo facility. That has occurred. And the next step down the line would actually be for the Fed to take control of central clearing of treasuries themselves. And that would end up extricating, if you will, the role played by the major broker dealers in terms of their facilitating of treasury financing. Bear in mind, there's a very powerful group. I'm sure this entire group is familiar with the Group of 30. And on July the 1st, they did come out with a paper advocating for central clearing of treasuries. That was an international advocacy, if you will, of taking this route. And that's very important because it does indeed salvage and protect the reserve currency status of the US dollar if the sanctity of treasury trading is made permanent by central clearing through the Federal Reserve.
Excellent point. What we'd like to do is our second poll at this time, and after that we'll do the question and answer portion. So the second question, and this is, as Danielle was saying just prior to the call, this is pretty prescient question today. And it is simply, does the debt ceiling matter? So we'll wait a moment.
I feel like we should have the final Jeopardy music going on in the background. Exactly. Thank you, Lisa.
I'm pleased to say that we have 85 attendees today. So out of those 85, it looks like 65 have participated, and I think looks like everybody's done. Everybody that's going to answer has answered. So you can see that 62% of the people that answered the polling question of does the debt ceiling matter, the majority, 62%, said yes, and 38% said no. So Danielle, perhaps that's the first question. What do you think? Does the debt ceiling matter?
Well, again, so we're speaking in terms of the need for treasuries, and especially in an environment that we have today when there is legislation that is being contemplated. We're talking about a big vote on Monday, a budget resolution. Everything the United States government does has to be funded. And as of July the 31st, when the debt ceiling was hit, nothing can be funded, not a treasury bill, note, or bond. There have been almost 100 times since this debt ceiling has been about that there have been these moments, and every single moment has passed without fail, and we've ended up increasing the debt ceiling. The last time the debt ceiling was increased was in July of 2019. That gave whoever won the presidency in 2020 the unfettered ability to increase debt through July the 31st of 2021, which we've seen. Now that we have hit that ceiling, and because the current $3.5 trillion proposed stimulus package has become such a political hot potato, the Republicans, the GOP, are playing much more hardball than they were or would be normally when it comes to the debt ceiling. And in fact, when you hear Democrats say this is the Republicans refusing to pay for debt that was run up during the Trump years, that's not incorrect. So you have to bear that in mind. But I will take you back in time to, I think, the year that is the most important to go back and study and Google after today's discussion, and that's the summer of 2011. The summer of 2011 was the last time really that there was this much of a standoff, that there was this much brinksmanship with respect to the debt ceiling. And over a very stressful period, we ended up seeing the S&P 500 drop by 17%. We saw the 10-year yield drop by 120 basis points. That's barely feasible today. You wouldn't even be able to see it in a nominal sense. But you saw gold fly in that type of an environment, and in the stock market, consumer staples, really the safest haven, the most defensive type investments, they were the only ones that provided shelter for investors, for their portfolios, as the debt ceiling became, again, more and more tempestuous. By the time it was finally passed, it ended up flowing into 2013. We saw a government shutdown. And by the way, there were some Fed meetings, there were some emergency Federal Open Market Committee meetings held in the interim, some of which John Dizzard at the Financial Times, if you didn't read his column a few weeks ago, please go back and read that. But there was an emergency FOMC meeting with regards to this. And as bizarre as it may sound, there is a blueprint, there is a pathway by which the US Treasury can strategically default on certain treasuries, specifically because the Federal Reserve owns so many of them on their balance sheet. So there is something called Section 8 and Section 9. Again, these are two things that I would highly recommend that you take a note of and Google after today to better understand the way that the Fed could technically, because remember, the interest that the Treasury pays to the Federal Reserve for the treasuries on the balance sheet at the end of the day, once a year, is remitted right back to the Treasury. So it really is a bit of an accounting maneuver. So you could theoretically say, if you're Treasury Secretary Yellen, that there might be no harm, no foul. It's not as if you're defaulting on a treasury that China or Japan or a hedge fund or a public pension fund own, but rather you're delaying an interest payment held in a treasury owned by the Federal Reserve, and that therefore once the debt ceiling is resolved, then that interest would be made whole. But again, you're not creating any kind of a public type of spectacle, but at the same time, in fact, many of us were at Camp Kotok on August the 5th, 2011, when S&P downgraded the debt of the United States because it appeared that the debt ceiling was not going to address long-term entitlement spending. We're in the same situation today, where again, long-term entitlement spending has now been flagged by Fitch, as well as political dysfunction. So we're definitely on watch in terms of Fitch and Moody's. And if this nuclear option, which I'm writing about right now, if this nuclear option of the strategic default is pursued, then I think that there's a very high likelihood that Fitch and Moody's would be forced to follow Standard & Poor's a decade later and downgrade the debt of the United States. So right now, the stakes are very high, and the Democrats are, and this has been all over the news for the past 48 hours, they are trying to put the debt ceiling into the budget resolution that should be voted on Monday. And Mitch McConnell has said you will not get those 10 votes that you need in order to raise the debt ceiling or even suspend the debt ceiling. There are 46 senators, GOP senators, who also several weeks ago signed a petition saying that they would not raise the debt ceiling. So it is increasingly looking like there is going to be an impasse. There is going to be a government shutdown, that Janet Yellen is going to have to continue to pursue extraordinary measures as they're called. And again, as it pertains to today's subject of the plumbing of the financial system, you will continue to see money market funds desperate for any kind of a yield, increasingly tapping into the Fed's reverse repo facility in order to get that yield. There is the chance, because the Fed is fighting that bottom floor, that they might have to increase once again the floor. Right now, the floor was raised to 5 basis points. There's a chance they might have to raise it to 10 basis points. We will see. But in any of the statements or the minutes that you see in the next coming weeks, pay attention to what they're doing with the plumbing.
Interesting. One of the things that you quickly alluded to was, in a way, one of the questions that we've gotten from the audience, which is, do you see a credible threat to the United States dollar's status as the world's reserve currency in the next 5 years?
So as my boss Richard, we had a long discussion yesterday. As my boss Richard used to say, the dollar remains the most attractive horse in the glue factory. That has not changed. It really hasn't changed. I actually heard recently, I was out in California and I was presented with a very credible argument because we're going to have the equivalent of a European sovereign bond of the euro possibly rising enough in stature in coming years that it could pose a challenge to the dollar. And of course, we are seeing, despite all of this drama that's coming out of China, seemingly every single night, with China trying to have a contained explosion to take the speculation and the heat out of their property sector, there is always that possibility that we could see a continued appreciation in the value of the yuan, and that it one day may be in a position to take out the US dollar's reserve currency status. I don't see that as an immediate threat, but when you see brinksmanship and when you see an inability to cross the aisle such that it comes down to government shutdowns and legislating only via reconciliation straight down party lines. These are the types of stalemates and dysfunction, to use Fitch's words, that do place the United States ultimately at risk of potentially losing reserve currency status.
Mm-hmm. One of the questions that was just put up by a member of our audience today is that, do you think, would Congress actually cause a debt default, that nuclear tactic? What would you say the odds are for Congress actually causing a debt default?
Well, again,
or allowing.
Well, and it would have to be allowed, and you would have to see Mitch McConnell have full control of every single one of the senators on the GOP in order for us to get all the way down that path. But if they were to back off anytime soon, I would be shocked because of how very tough they've been talking. And the flip side of it is that it doesn't appear that there's going to be an olive branch in the form of Nancy Pelosi being able to bring her caucus together in the House of Representatives to pass what the Senate has already passed, the bipartisan infrastructure bill, which could buy some goodwill on the part of the GOP and reopen doors to negotiation because of the far left progressives in her caucus who are insisting that they will not vote on the bipartisan infrastructure bill unless it's done in tandem with the $3.5 trillion larger infrastructure bill that they're looking at. You could see brinksmanship get to that level. And again, I lay you money that Ben Bernanke and Janet Yellen wish it was not a matter of public record, that there is a means by which to, again, and the term is strategically default on treasuries with the assistance of the Federal Reserve, given its very large footprint in the treasury market. I hope we don't get there, because it would cause, I think, tremendous turmoil in the financial markets. But again, if you're listening to one side or the other, they're both talking really, really a tough game right now.
Mm-hmm. And they really are indeed. Would you comment about the Fed's use? This is a question from one of our GIC members. Is the Fed's use of the Fed funds target outmoded as a way to control short-term interest rates and influence the yield curve?
The Fed funds rate itself as a singular tool, and we forget that it used to be, prior to December the 14th, 2008, it used to be the only tool before the introduction of unconventional monetary policy and quantitative easing, and now reverse repos and standing repo facilities. So there used to only be one tool in the toolbox. And in the sense right now that the Fed is trying to hold down interest rates via quantitative easing, via large-scale purchases of treasuries and mortgage-backed securities, at the same time that it's also defending the floor by trying to make sure that overnight rates don't go into negative territory, which we have seen in certain overnight repo and treasury bill markets on an overnight basis. Because they're trying to defend the floor and the ceiling at the same time, it does appear that it is difficult for the Fed to use the tool of the Fed funds rate in isolation. And I think that that's why they're realizing and trying to implement and get greater control over the broader treasury market, because interest rates alone are proving to be too blunt of a tool.
Mm-hmm. Mm-hmm. I've got a couple of questions from the audience, which I'll ask in a few moments, but we did have some questions sent in advance. One of those is from a GIC member. Could you comment on suggestions to crowding out the private sector out of short-term funding markets to ensure stability?
So this is what we're talking about with the standing repo facility. So when we were kind of in the darkest days of March of 2020, I remember speaking to one of my clients who's very active in leveraged treasury trading, and he hadn't slept all night long. The long bond had stopped trading in Asia overnight. These are unthinkable moments. You can't even conceive of the possibility of the risk-free asset of the free world stopping trading in the middle of the night. But that is in fact what happened, and I think that this is actually the catalyst for the Group of 30 paper that came out. This is why Lael Brainerd and others have been looking into central clearing of treasuries, so that they can extricate from the process banks that do or do not want to deal, and can and cannot deal. Some of it is by choice. Ask Jamie Dimon. I didn't say that, but what the Fed is trying to do is to ensure liquidity in this very critical market. But if central clearing of treasuries is pursued in its purest form, then you will indeed have made redundant, in a way, a lot of the biggest banks. And we can discuss in a little bit central bank digital currency and how that would further the redundancy of the conventional banking system as we know it. But again, they are designated broker dealers for the very reason that they help enable the functionality of the open market operations at the Federal Reserve.
Mm-hmm. You actually, we might as well go there now, because one of the questions that was sent in advance was, how do you see the role of cryptocurrency in the next evolution of Fed policy? So how do you see the role of cryptocurrency in the next evolution of Fed policy?
Well, it's fascinating because Gensler has been testifying, SEC Chair Gensler has been testifying about cryptocurrency, about the lack of regulation, the lack of understanding, and about the potential important role that central clearing of treasuries could play on a move forward basis. So these are really timely subjects. If you're asking me about central banks and the role that would be played in the crypto world, we really have to talk about a central bank digital currency. And that is what has been being piloted in China, and the other two countries, of course, that have pursued them in their purest form are Venezuela and Russia. And that is why I think the difference between Jay Powell and Lael Brainerd is as wide as it is. Jay Powell has always stipulated that if there was to be a central bank digital currency, or a so-called Fed coin, that anything held would have to be equally anonymous to the dollar bill in your wallet, that it would not be able to be used as an instrument to effectively spy on your population. And that's why you hear some arguments today that say, the United States may boycott the Olympics in China if China insists that the only means by which to transact is going to be in their central bank digital currency. That would effectively be allowing the fox into the hen house, because then China's authorities would be looking into individual Americans' financial transactions. But again, when it comes to the slippery slope of marginalizing the conventional banking system, when you're talking about a central bank digital currency, when you're talking about the potential for especially underserved, underbanked Americans to have accounts directly at the Federal Reserve, the reason more conservative policymakers try and stay away from this subject is because it is effectively a slippery slope towards the facilitation of modern monetary theory, because you're bypassing, if you will, the need for there to be an intermediary. You are printing money at the Treasury, and it is directly going into the pockets of Americans. And that is what Lacey Hunt, for all of you who know Lacey's Hunt, long and large body of work, that would require an act of Congress, because you would be effectively making Federal Reserve liabilities legal tender. And again, I think that is one of the reasons that you do see the difference between Lael Brainard and Jay Powell, that I think Lael Brainard's, and I'm going off on a bit of a tangent here, but that's all over the news right now as well. But that's one of the reasons I think that there is such pushback, and that there would be so much difficulty in confirming Lael Brainard, because there is quite a bit of anxiety that the path towards socialism in America, the path towards modern monetary theory, would be facilitated by somebody who was more amenable to a central bank digital currency than Jay Powell is and has been public about.
One question that was brought up by our live audience is, the question states, don't the various Fed measures such as QE, SOFR, reverse repos, etc., mean that the Fed is increasingly enabling the congressional standoff on the debt ceiling? And that question was phrased also in another way. How is modernizing the system funds flow under the Federal Reserve and not congressional province? Is there mission creep between the Federal Reserve and the Congress? So is the Fed increasingly enabling the congressional standoff on the debt ceiling?
In the sense that the Fed can facilitate or be the conduit through which a strategic default is played out, then you certainly, and this is why, again, I do recommend the Financial Times, and I'll send a link out, that John Dizzard's article in the Financial Times. He quoted Jay Powell as saying that this would be a loathsome path for the Federal Reserve to take, because it would politically place the Fed in the middle of congressional proceedings, which is a huge no-no. As a 9-year veteran of the Fed, that is something that is absolutely never done. And if I can go off on one other slight tangent, I think that that's why it's a bit of kabuki theater right now, that there's such anxiety about the Fed initiating a taper. The Federal Reserve never has a major policy shift in the midst of large political events. They wait until they're resolved, so that there is not even the appearance that the Fed is trying to side with one or the other party in order to smooth what they want to accomplish politically. And by the way, also pack in the back of your mind that the Fed does not like to change policy in the month of December either. That is an unspoken tradition.
It's interesting because one of the attendees asks, what will it take to remove politics from the Fed matrix?
Oh boy. Well, I only wrote 236 pages about that subject.
Read the book.
Well, and I'm not trying to say read the book. I'm really not. But I will say that at the time, in in 2008, when the Bernanke Doctrine was conceived behind closed doors at Jackson Hole, without a full quorum, without every member of the FOMC in the room, when the Bernanke Doctrine was conceived, it stated that the federal funds rate had to go to zero before quantitative easing could be launched. And that was something that was a presupposition, but it was a presupposition among a small majority of those on the Federal Open Market Committee, but certainly not an overwhelming majority. There were some, including my boss, there was Jeremy Stein, this guy named Jay Powell, Charlie Plosser, good friend of GIC's. There were some who felt that the zero bound in and of itself presented challenges and would encourage bad behavior by investors, speculation, malinvestment, and pushing investors further out on the yield curve than what would be appropriate, causing public pensions to go where they shouldn't go, into alternative investments, etc. So it's interesting that the idea that the Fed has not been politicized is even a question, because the minute that the Fed went to the zero bound, it effectively took away the responsibility of Congress to legislate, because it's pretty darn easy to run up the federal debt the way that it's been run up. If the only thing the government has to concern itself with is interest expense, and when interest rates are at the zero bound, there's not a lot of it. In fact, Janet Yellen recently made the comment that from the last time she was concerned with the national debt in 2017 until now, interest service on the debt has become less of an issue. Again, that is in and of itself, and I think it should be recognized as an admission of the political role that Fed policy has already played in America and in policymaking.
Mm-hmm. That really leads, it's amazing how well your answers are leading into other questions. Another question from one of our online participants is, in your opinion, what is the greatest risk to the financial markets and the economy? You've spoken about the fiscal cliff, stagflation, corporate debt buildup, valuations, and how much longer the Fed maneuvers can hold off the financial market declines. In other words, is the Powell put eternal?
Well, that's a very valid question. And I don't know that the answer exists right now, because we have to remember that in the aftermath of the financial crisis, that monetary policy alone was sufficient to address the ills within the financial system, the liquidity facilities that were rolled out by the New York Fed. I was there at the time. It felt like an alphabet. We were just drowning in an alphabet soup, whether it was a commercial paper or whether it was the repo market and Zoltan Pozar and his huge map and where the stresses were, and Maiden Lane and Bear Stearns. But at the time, and as dramatic as it was, and that was the Lehman moment, the Federal Reserve, again, as a standalone entity, was able to address the ills of the financial system and right the system by creating more debt. So it was a household balance sheet issue going into the financial crisis. It became a corporate balance sheet issue in the decade that followed, and that indeed was where we were seeing systemic risk begin to percolate in February and March of 2020, when the pandemic hit. What we've learned subsequent to that is that the Federal Reserve alone, despite the size of the bazooka, despite the magnitude of the quantitative easing, despite the de facto marriage of the Federal Reserve and Treasury and off-balance sheet vehicles a la Enron that were placed on the Treasury's balance sheet, the Fed spent very little money, but speaking to backstopping the corporate bond market was absolutely critical. Grandfathering in any triple Bs that were going to be downgraded as fallen angels, saying that they would remain basically effectively investment grade. These were critical functions that were played out by the Federal Reserve, but they weren't sufficient. In order to address the magnitude of the stress in the system, we also had to have this little thing called a 43.2% fiscal injection directly into the economy, directly into the veins of Americans, stimulus check 1.0, stimulus check 2.0, stimulus check 3.0. Covering Americans' rent when your rent is on average $1,800. There was a report that came out of the CBO today that showed that on average renters' credit scores have increased since the pandemic broke out. Well, of course they have, because their rent has been covered. We have not had a household credit cycle in any way, shape, or form. We haven't had subprime automobiles blow up in terms of their default rates. My point is, a single-barreled approach was sufficient after the financial crisis. Right now, we required a double-barreled approach, which calls into question whether or not the Federal Reserve alone would be able to address another moment, another black swan, if you will, if there is continued, and there will be continued. We are heading into a midterm election year. There is no reason to think that they're going to play nicer in the sandbox headed into an election year. There's every reason to think that things could get uglier as the GOP looks to take back that 3-seat swing in the House, as the GOP looks to take back the Senate. So there is that risk out there that the Fed put alone would not be sufficient.
Mm-hmm. We have a question from a good friend of the Global Interdependence Center who asks gently, why criticize the Fed since they are the only adult in Washington?
The only adult in Washington. I don't understand. I mean, with due deference to however good of a friend you are, I don't know that being a drug dealer and increasing the amount of drugs you give to the drug addict is necessarily adult. And that's the best analogy that I can use. And I'll fall back on Richard Fisher again, because he was always the one that used that medical analogy. So again, I don't think that facilitating greater creation of debt in order to resolve a debt an over-indebtedness problem is necessarily mature and or responsible or good for the country.
Mm-hmm. Well, what is your thought? Do you believe that the Fed is concerned with China's holding of U.S. debt?
Well, I think that the Fed could be concerned with,
or should they be, or
well, potentially, but now if we are headed in the direction of central clearing of treasuries, then you effectively mitigate, you negate, you nullify the potential threat of others in the treasury market, because you are controlling the treasury market. And again, that is why the endorsement, the effective endorsement by the Group of 30 of central clearing of treasuries was as critical as it was, because that meant that the United States could not be placed in a precarious position as in its position as the ultimate provider of liquidity, as the holder of the risk-free asset. So again, I highly recommend that you go back and look at, and it was Timothy Geithner himself who was the main author of that Group of 30 paper that came out recently.
Mm-hmm. Mm-hmm. Do you have any insight on how the dynamic between gold price and long treasury premium evolved? Do you have a thought about gold versus long treasury and the price differential?
I did at one point pre-Bitcoin. So my brain has been so scrambled by the role that Bitcoin has played in terms of mucking up the traditional relationship between gold and the treasury premium. And I will say that at Quill Intelligence, we did go, and this isn't answering your question, and the answer is I don't know. I always answer I don't know if I don't know. But I will say that we did go back and extensively look at every single asset class in the world. And the one that we found had the greatest correlation with Bitcoin was the growth of negative yielding sovereign debt. So there's definitely a trade-off there, but I will say on a personal level, I certainly have not given up my gold holdings, because of late, you've also seen the correlation between Bitcoin and really racy stock prices increase as well. So I do think that there is a role for gold. I would also look back on the history of gold and remind whoever is listening right now that gold has also outperformed even in times of deflation if there's sufficient disruption in the financial markets in terms of it being the ultimate safe haven.
Here's a question from your moderator. Average investor should allocate some money to gold, some money to Bitcoin?
The Bitcoin I can't tell you about. I think that the price and the role of cryptocurrency, and this is my very cynical take as a former bureaucrat at the Federal Reserve. When I first joined the Fed, the caliber of talent on the New York markets desk was second to none, basically because Wall Street had just fired a lot of people who needed to keep health benefits. So the best and the brightest were populating that New York Fed's markets desk when it was needed the most. And then once Wall Street opened back up for business, they trailed off and got their higher paying, former lucrative positions. The reason I bring that up is because it's apparent that the regulators haven't figured out crypto enough to figure out what to do with it. And I don't think until the ink is dry on how regulators are going to approach cryptocurrency. Gensler today referred to it as an asset class. I don't think that Bitcoin purists would refer to it as anything else other than a currency. So there's even a dispute in terms of how how a cryptocurrency is defined. So it's very difficult for me to say the role that cryptocurrency should play in an investor's portfolio, other than to say, if you like really, really racy, volatile asset classes, sure, plunk 5% in there. Gold, however, I would say should definitely be a core holding, and you should be pretty bold about gold, again, because it does perform well during times of financial disruption. And we have seen corporate credit risk. We have seen corporate credit spreads start to tick back up. And again, that was what precipitated the need for true QE. It was because there was an event that was building up in the system. There was counterparty, there was credit risk. These terms started to roll about in late 2019, and now we're just starting to see for the first time since the March 23rd bazooka bailout of the Fed, of the corporate credit market, we're just now starting to see and hear rumblings about there being too much risk on corporate balance sheets again. So that's something to be cognizant of.
Mm-hmm. Mm-hmm. And there may indeed be so. We have another question from the audience. To what extent do the current or past members of the present Senate and House Banking and Finance Committees understand the issues that you yourself are bringing up today? And might they hold hearings on these issues? Do you think there's a chance of that this, again, the idea of the Federal Reserve getting more into the plumbing of the financial markets, is this cause for concern? And if so, does anybody in the Capitol hear you, or would there maybe be hearings on the subject?
I will say without saying that my work has made its way into certain people's hands. On a bigger level, I would also say that when I use terms like banks being marginalized, I don't think banks like that idea. They don't necessarily want to be in the business of repos. They don't necessarily want to be in the business of treasuries. The margins are wafer thin. However, they're also a testament to the power position that they hold within the financial system. And I would say that the lobbying power of the biggest banks is something that you cannot discount in terms of whether or not there's going to be greater power given to the Federal Reserve. I don't think the banks are just going to roll over and say, okay, they can have it. So I do think that these are subjects that would indeed become a matter of public discourse, public debate.
Very good. Very good. There is a question that was sent in prior to today. What constitutional amendment under COS Article 5 could fix the fiscal mess created by the federal government?
I mean, the long story short is you need to require the budget to be balanced. And
Right.
I mean, good luck with that.
Right.
So, I mean, again, regardless of the party, I think fiscal profligacy is a horse that's left the barn. I don't think it's specific to Democrats. I don't think it's specific to Republicans. They'll use it as a political weapon, but in terms of any kind of frugality or approaching the balance, the budget in a mature. So they're also not adults in Washington, D.C. for whoever the special friend of the GIC was earlier. So maybe the people at the Fed are a little bit older. Maybe they're 21 and the people in Congress are 18.
One thing that's interesting, we've had a couple of questions come up about can the Federal Reserve tilt monetary policy to address issues like climate change or inequality. And if you have an opinion on that, please share it. But I would like to share with the audience that those are issues that we have talked about on separate GIC events, and particularly the climate change and its role in economics and inequality and so forth. So we have other things. If you're welcome to look at the GIC website to search for those. I think we've covered a lot of ground here and a lot of great questions. I will simply say that you have given us a terrific amount of things to think about. And I ask you, Danielle, please, as we begin our close of today's session, will you give us the 2 points that you want every single person on this Zoom to take home with them and either take action on or think about and be aware of?
Well, I think that the one thing that you should definitely take away is that because the subject of the national debt and the tool, if you will, of the debt ceiling has been weaponized, I think that it is time for the politicians in the United States to look at how to finance the country in a different way. Because if there's dysfunction in the tools that they have, we're talking about the tools that the Federal Reserve has, but if this has become effectively a dysfunctional means by which to try and be rational about our national debt as it runs up past $30 trillion, then it looks like we need to go back to the drawing board and figure out a new way to address the fiscal finances of the country. I think there needs to be a complete reengineering, rethink, rethought on that. And then the second thing that I would add is that it's going to be, if you're interested in the plumbing of the financial system, it's going to be very interesting in the weeks and the days and the weeks and the months that come to pull up the Treasury General Account on your screen, the TGA. It's just pull it up in Fred and watch that balance come down. That balance is about $200 billion right now of cash that the country has left in its checking account, so to speak, because it will, if the brinksmanship does get as ugly as it possibly could, then the extraordinary measures could become very extraordinary compared to what we're used to. And again, let's pay attention to the increased role that the Fed is called upon to take as we see the politics get uglier as a factor of time and indeed headed into next year's midterms.
Mm-hmm, mm-hmm. Well, those are two great things for us to take away. Thank you for this great discussion and spending time with the GIC community. Danielle, you're always an asset to me and I know an asset to everyone else. I would like to thank in the background Jill and Colleen and Siona for making
Fiona,
sure
thank
everything.
all of you. Yes.
Yes, everybody at the GIC background that's doing what they're doing to make this work. We appreciate you. So as a reminder before we close, a replay of today's executive briefing will be available on the GIC website later today. We are happy to announce that the GIC will be continuing in-person conferences in 2022 with events held in Nassau, La Jolla, California, Sarasota, Florida, and Paris, France. And more of those details are available on GIC's website, which is interdependence.org. So please take a few, take exactly 60 seconds to respond to our audience survey, if you will. Your feedback is critical to us and our programming efforts, and we appreciate you letting us know exactly how we can improve our programming. We welcome your thoughtful and meaningful criticism and compliments. We thank you and hope you will have a great rest of your day. Do stay healthy and do make sure to take advantage of all the great things that are available on the Global Interdependence website. And with that, we thank you.